So Feroze Azeez, joint CEO at Anand Rathi Wealth. Feroze, thanks a lot for waiting so patiently. I hope you've been well. Market-wise, things have been looking fairly okay. But I would like to point out that the reaction to second quarter results that have been fairly upbeat, and of course the emphatic NDA victory in the Bihar polls have been lukewarm to say the least. Would you concur, and what is it that's stopping the markets from taking off? Because quite a few pieces of the puzzle are now coming together. Political uncertainty out of the way, earnings not as bad as the street was fearing, and now there is chatter about the fact that an India-US deal could come by very soon. We have Trump and his entire team actually making such comments. So, what is it that's stopping the market really from taking off from here? Do you think a lot of it was already in the price?
Good morning, Nandita. See, I don't know whether this is called stopping. The lowest level of the last 1 year was 22,082, which was on 4th of March. So the point I'm trying to make is, if you look at it from the trough, it's almost 18% higher. On the day when Trump announced and tried to create panic in our capital markets with the 25% tariff and then backing it up with another 25%, Nifty was at 24,400, which is about 7% higher. Somebody like the world's strongest voice tried to correct you by 10%. On the contrary, you're 5-7% higher. It's all about expectations and reality, right? If I'm expecting that hunky-dory situation is 30,000 Nifty, then of course 26 will look abysmally small. But if you're looking at peak to trough, peak was September last year, 26,200. So that's point one. So look at it from where we are. We're just 1% away from the peak, and practically 17-18% away from the trough of the last 1 year. And that's in spite of so much negative news. Time and again, global uncertainty, the kind of AI bubble which people are talking about. And in spite of that, you're at peaks. And I personally think the earnings on the Nifty companies haven't been so great. I don't know why is the narrative being built that it's been great. 1.7% is the Nifty earnings for the last quarter. Not that I'm disappointed, because that was what was expected. 1.7, there are about 11 companies, which 9 companies, 10 companies gave degrowth of greater than 10%. 15 companies gave growth of more than 20%. And the rest of the 24 companies gave growth of 0 to 20 year on year, same quarter.
That's true, and we'll dissect the earnings, more granularly in just a bit. And I take your point. Barring a few sectors, the Nifty universe hasn't really handed such a great report card. But before that, let's do some crystal ball gazing, right? Goldman Sachs has recently upgraded India, and they believe 2026 will be a blockbuster year. The Nifty target at 29,000. You were mentioning 30,000, but they are close, 29,000. That's an 11 to 12% upside from where we are right now. So do you think that's a possibility? Do you think 2026 will be far better, given the fact that last 1 year we have seen underperformance vis-a-vis emerging markets? We've been flat if you look at absolute terms, and that's despite all the spate of negative news, as you pointed out. So that's a good thing. But do you think 2026 is when we take off and a double-digit up move is possible, just like Goldman Sachs is pointing out?
Yes, Nandita, definitely there is more upside than downside. There's if you look at the FII inflows, are going to reverse the next 3 months is my prediction. Active FIIs have sold as much as they could. Passive FIIs are building up positions. If you look at the vanguards of the world, which follow FTSE, you will see huge position build up. Unfortunately, camouflaged by the active FII selling, moving to China and stuff. But I upgraded India on 4th of June when the election counting was happening, before the counting, if you remember, on money control, of course. 21,700 was very apparent that there was not too much fall. Any equity investor should always assume that I'm cutting a check, I will see 10% fall. At 21,700, we thought that the markets would do well, because for markets to fall, the prime requisite is huge selling. Where does selling come from? If you dissect selling into domestic, foreign three kinds: proprietary selling, active FII selling, passive selling, and then you dissect it between cash market and derivative market, index future selling. All of it was already sold, and currently the status is again heavier selling than buying. 88% short positions in index futures, FIIs having sold 1.5 lakh crores, net zero inflow for the last 5 years by FIIs. All these are positions which are light positions. In light positions, markets don't fall. I personally think any positive trigger has a reasonable potential of a short covering, and 27, 28,000 Nifty is very likely. Of course, those are numbers. Broader market earnings have been very good to give the statement credibility, Nanda. Almost 17% earnings growth for in a small cap 250 stocks, which I think is great earnings. Nifty, of course, I showed the other side of the story, 1.7%. Mid-cap earnings have been 22%. The 150 stocks have been 22% growth year on year for the same quarter.
True that. Of course, mid caps have done fairly better than large caps if you compare it on earnings basis. But let's also talk about the concerns around the AI bubble that's forming in US tech. We've seen some marquee names step back from Nvidia. That's been an AI darling, as you all know. What if the AI bubble bursts? Would there be a spillover impact on India, and a positive one? Because a lot of people are talking about India as an anti-AI trade. Could foreign investors then look towards India? Because right now they are looking at China and other markets because they are compared to India cheaper valuation wise, plus they are getting AI as well. But if that AI bubble bursts, do you think India would feature higher on the list vis-a-vis all these other cheap EMs, or do you think that would be too far out to predict?
I think first, the bubble bursting will have a larger collateral damage irrespective of which capital market you sit in. Of course, in the long run, it could be beneficial because AI bubble is something which AI as a stream we have not participated, and I don't think there are any listed players in the capital markets which can take huge advantage. Even our technology sector has been a laggard in terms of innovation, and that's one crib which each of us have had with the Indian technology. They have their business models are different, and there's nothing wrong with that. But coming back to AI bubble, if you look at S&P 500, 1 year return is about 13%, NASDAQ is about 20%, Dow Jones is about 10-11%. Of course, the stocks, the AI stocks have, all the technology stocks have run up, especially the larger weightages in NASDAQ. But I personally think as long as the broader market has in the US has not run up 30, 40, 50%, the AI bubble bursting will definitely have damage, not such a large damage. Like if you go back to 2007 rally, it was a broad-based rally. S&P 500 had risen almost 42% and 50% for Dow Jones. So when that kind of a rally, broad-based rally happens, corrections are very, very steep. When there are fewer pockets which have rallied, and that is, of course, resulted in 13, 14%. So what am I trying to get to? India might have long-term benefit, but if the AI bubble bursts, we will also be caught in the eye of the storm. That's point one. Point two, will the damage be very large, like 20%, 30% correction on the broader US market? Very unlikely, because 1 year return is 30. Generally, when a bubble crashes, you erase the last 1-2 year return, not 20-year return, in my opinion, and unless you're looking at a Japan kind of a bubble in the 1980s.
Sure. But what are your thoughts? Do you think the AI bubble is about to burst? What are you picking up with the conversations that you've had so far with your global investors?
See, I think bubbles burst. It's about the timing of it. I personally think it's not going to be very easy that the AI bubble bursts. Why? Because there's a lot of index fund investing in the US. 90%, 80% of the money is invested in a formula method, and human judgment is near zero. For only 10%, there's human judgment. What does that mean? If the AI stocks are the heavyweights in the US market, there's more money coming in, creating more weight. More weight is creating more money coming in, and that's resulting in price rise. So it's a vicious cycle. So breaking that cycle in India is very easy because we do out of our 47 lakh crores of mutual funds, 12 lakhs is passive and 35 lakhs, 36 lakhs is active. It's the other way around. For the US, for the bubble to burst, the top 6-7 stocks should have substantive selling. Now, in an index fund kind of a overall economy or capital market, it is difficult to burst. So I don't see that happening in the next 3, 4, 5 months. I think it could happen after a further rally, not just yet.
Okay. Point taken. I think I was talking to Mr. Ajay Bagga, market veteran, yesterday. He said the same thing, that it's not that easy for the bubble to burst, and it could at least take another 2 odd years for that to really happen and see a substantial crash in the US markets. But back home, let's talk about earnings as well, since we were talking about it just a while ago. Most of the outperformance, as you mentioned, is coming from cyclicals, metals, OMCs, cement. When you strip this out, of course, the Nifty universe isn't looking all that great. It's actually flat to perhaps down. How should investors really interpret this for future earnings, rest of the quarters and FY27 as well? Because a lot of us are penciling in a double-digit earnings for FY27. Do you think that's far out? Is that a possibility? At least for the Nifty universe, how is it looking?
Our estimate of earnings growth for Nifty was close to about 12% on a base of 1,092, if I'm not wrong. The earnings growth for the last financial year of Nifty was about 11% because there were four constituents of Nifty which changed. So where did Nifty end its current constituents ended its earning at about 1,090? I personally think a 12% earnings growth after this quarter, Q2, gets more solidified than weakened. That's point one. Point two, after a time correction of a year and a price correction of 1% only now left, I personally think the probability that the next 3 years, and this is the most important raw material for one to create the portfolio, next 3 years, Nifty delivering more than median return of its historical past, which is 11.3%, is 95% and above. So if you get a raw material of 11.5%, building a portfolio to get to 14-15% return with a risk level significantly less than Nifty is possible. So I personally think the odds of that happening from here on, you can mark me on this one, is very, very high, upwards of 95%. 11% plus returns compounded on Nifty can create huge opportunity for one person to build a 14-15% portfolio if that's the raw material you're receiving.
Okay. Interesting. Then which sectors do you think can actually deliver that double-digit revenue growth here on? And which are the, how should investors really position their portfolios in the wake of that? Chase momentum, rotate to value, or perhaps stay defensive, for building a portfolio for the magnitude of gains that you mentioned. How should one go about it?
Yes, I personally think you should, if you're a investor, I personally think top-down is a better strategy than bottom-up for an individual investor, because identifying a stock and doing research on 500-700 stocks and then picking it up is it's very good to hear that, read a balance sheet, understand, but there's 20 other things to understand, and you can't do that. 20 into 1,000 is 20,000, right? Data points you'll have to look at to create a portfolio with 20 stocks. So I personally think you have to look at which are the sectors which can outperform Nifty by 3-4%. If that's the case, I would say auto, banking, and consumption. These are the ABC, of course, the acronym is ease of remembering, can create an alpha over compounded periods of 3 years, a 3-4% alpha. And one offbeat theme is the Nifty capital market, which Motilal Oswal, I think, did a fund as well. So Nifty capital markets, today you are, everybody speaks of financialization. Today, you don't have one stock from capital markets represented in Nifty. Will that be the case in the next 10 years? I personally think at least 2-3 capital market stocks out of the 15-16 which are there will form a part of Nifty, and that will create a re-rating. And if you can get into Nifty capital markets, of course, I have to give the disclaimer, we are a part of the Nifty capital market as a listed company. But I would be reasonably bullish that if India has to get financialization, capital market needs to get some representation in the largest index of the country.
Sure. Since you mentioned capital market stocks, and of course, I want to just point out what GROW has done. I'm sure you won't be commenting on specific companies, but 1 lakh crore market cap, it's actually created a frenzy, right? Does this signal froth in consumer tech valuations? What should retail investors do when a stock rallies 60% or 70% in just like 4 sessions?
You see, that's exactly why. Every stock might have the same output, but the input is very different. Consumer tech might be an umbrella where somebody is broking house, it's accumulated lakhs of active users. That's a very different recurring purchase and sale transaction. Now, if you look at somebody else selling a commodity on technology platform with 2,700 different stores, that's also called consumer tech. I think they're completely different business models. Might throw up the same output that they rallied, both of them rallied after getting listed. But that's why bottom-up stock picking has so much more to see in the input side than just the output and the headline or the name tag, as we can call it.
All right, that's the thought then. I want to get in a few more thoughts then. Bets of a rate cut in the US may be fading, although yesterday we had Waller once again saying that, given the fact that labor market is weakening, the case for a rate cut is still there for December, but a lot of others have said that we shouldn't be going in for a rate cut. So yes, their chances are receding. But back home we've had a record low inflation data, and there's a chorus growing that we could see 25 or another 50 basis point rate cut by RBI as well. So my question is, for retail investors, does it make more sense to increase exposure to debt funds, hybrid funds, or stay overweight equities? Because even in the last month's mutual fund data, we saw that equity fund inflows have slowed, but hybrid fund inflows have gone up. So what is the thought process there?
Yes, like you said, it's very apparent that the rate cut probabilities in India are going up substantively, point one. Point two, I think the core inflation hasn't come down. CPI has to multi-year lows. So I think the probability has gone up, not as much as what the CPI reflects. That's point two. Point three, already you see the yield curve, which was flat. This was a prediction repeated multiple times on different platforms, that we had a flat yield curve, which was impractical for an India. Now the short end of the yield curve, the 3-month paper has come below repo, which is 5.38. The 10-year paper is at 6.51. There's at least a 120 bips difference in the spread. The yield curve has again become upward sloping. Is there too much money to be made in debt? The answer is a big no. Most debt funds who would give you a capital appreciation will take 90% of it as a fee itself. So I personally think that's not even a play. Even if the 10-year GSEC comes to 5% on a 6-year modified duration, you make a 9% capital appreciation. Over a 5-year period, the fee expense will be 1.5% extra if you're actively managing the yields. So I personally think that's just a great selling story of a product, but not a great practical portfolio creation tool. Because net, you're going to still pay tax at marginal tax rate, because Section 50AA, which was introduced in Income Tax Act, treats debt as a very big detrimental tax instrument. So coming back to the point, I would say if the interest rates come down, you have a larger play, leveraged play on equity. So making money in equity is going to be so much higher. That's one of the reasons why I said the odds of Nifty delivering 11% plus compounded return over 3 years is high, largely also attributed to the interest rate softening over long periods of time, which we expect.
Also, flows into gold and silver ETFs, Feroze, have seen consistent inflows, right? Of course, a lot would argue, people would argue that this is a classic FOMO trade. But would this trend continue, or post December, January, do you expect this trend to kind of fade out?
Gold in dollar terms touched almost about 4,300. Now it's at 4,022 today morning in dollar terms. I personally think that if anybody's got debt in their portfolio, having 50% of their debt in gold in a staggered fashion makes sense, because rightly or wrongly, because there's no fundamental report ever read on gold. So with demand and supply estimates, in my opinion, 3,000 to 3,500 is where the average gold price could be. If you staggered half your debt money into gold and had the potential to hold gold without looking at prices, because Indians have this love for FDs and gold. So if we give them gold, if I give them equity, they will look at prices more frequently. If I give them gold ETF, they're more calmer. You can use that to weather the volatility and make almost twice the return post-tax on debt, because gold also throws up great tax efficiency, unlike debt. So net, what I'm saying is, silver is not even an asset. Any asset which can change price 5% is too volatile. If it can give 10 years of negative return, which it did from 2021 to 2011 to 22, it's not even formulated itself as asset, unless you are in solar panels manufacturing. Don't buy silver unless you're going to serve your guests with those vessels and utensils. So silver has not made the cut mathematically. Gold is a great asset for you to replace debt, not equity, but in a staggered fashion over the next 1 year.
All right, that's the thought then. With that, Feroze, would like to thank you for taking out time and sharing your thoughts. Always a pleasure, and I get to know, your new perspective. You share a new perspective with our viewers every time you join us, and I really appreciate you doing that. Look forward to our next one as well. Thanks a lot for joining in.